Hello and welcome back to my channel of Learning Made Easy with Rohit. This is Financial Accounting Part 7, Accrual Accounting, and today we will be specifically talking about deferrals. Now, before I get into the presentation, I got some comments from some students who are concerned about I using only the dollars, as currency in my presentations. I would just like you to know that it does not matter what currency you used. Okay, any unit of measurement. Okay, it could be dollar, it could be you're coming from a different country, it could be your Indian rupee, yuan, yen, any currency. The concepts, the basic concepts of the accounting are going to stay the same. Okay, so it doesn't matter what currency we use, the accounting concepts are going to stay the same. If you're comfortable, in doing the questions in your own currency, please do so. They will not change any thing as far as the accounting entries is concerned. In today's presentation, we will learn about the difference between accrual accounting and cash-based accounting. We will also learn to apply the revenue and expense recognition principles. And at last, we will learn how to post journal entries. Difference between cash-based and accrual accounting. In cash basis, the only transactions which matter and or are recorded are the ones where either the business receives cash or pays cash. In other words, some kind of a cash exchange is observed. So either you accept cash or you make a cash payment. Those are the only transactions that you will record. Now, the point that is most important and most relevant with the businesses who engage in cash basis accounting practice is when you sell something or when you provide a service, are you receiving cash or you're not receiving cash? You see, that makes all the difference. You receive cash, you record it. You don't receive cash, you do not record that transaction. Okay. There are many businesses, usually very, very small scale businesses, who will engage in cash basis of accounting. But worldwide, or when it comes to legal recognition, cash basis accounting is not given too much relevance. It's not really considered. So the focus of the entire series will be based on accrual accounting. Now, what is accrual accounting? In accrual accounting, you will record any business transaction where either you are earning revenue or you are incurring an expense, or if you are acquiring an asset or you are taking a liability. Anything. It does not matter whether cash has been exchanged. It does not matter. You could engage in a business transaction where the cash was not exchanged. You would still make the posting. You will still record that business transaction. One of the easiest examples to follow is when you sell something on account. Okay, on account, if you remember our previous presentations, what does that mean? You sell something, but you do not get cash payment on that very moment. You could have a contract with your customer. The customer is going to pay you at a later date. Could be a week, 2 weeks, 1 month. That is selling on account. So you're not getting cash, but you're still going to record that business transaction. So that is the basic difference. Okay, cash based, you only focus on the transactions where cash exchange has taken place. In accrual based, doesn't matter. It's irrelevant. You receive cash or you don't receive cash, you will still record your business transaction. We're going to do an example. Okay, consider an ABC corporation. Okay, in the month of September, they have the following transactions. Number one, they provided services to a customer for $4,000 and they got paid in cash. So $4,000 was a cash payment for services they provided to a customer. Number second transaction, they sold some products to a customer for $5,000, but this time the payment was not in cash at that very moment. Okay, this customer had a contract, was on account, so no cash transaction took place in this transaction. Third one, this corporation paid salaries to the employees for $1,000 in cash. Obviously, when you pay something, it has to be a cash payment. And the last one is it received electricity bill of $200 for the month of September. So please focus on this word, okay, received. All it means is you received the bill, you did not pay it yet, okay? So please make sure you understand the difference between receiving something and paying something. Okay, just because you receive a bill doesn't mean you're going to make a payment on that day. It takes time, a week, 10 days, okay, depending on the business, right? So we will see how these transactions are going to be recorded. The first one, we're going to focus on cash-based accounting. This is a condensed income statement. And again, just like I said before, okay, this is a very, very easy form. Income statements are not that, straightforward or, 5-line income statements in normal course of business. They are many, many pages long. This is just an example. Okay. So in cash-based accounting, you are going to record a revenue of $4,000. The salaries, $1,000, and your net income is $3,000. Obviously, 4 minus 1, so $3,000. Now, why did not we record all the other transactions? Okay, and the answer is very simple. We did not record those transactions because there was no cash that got exchanged in those business transactions. We did not either receive cash or paid cash. That is the reason, simple reason, we are not going to record those transactions for cash-based accounting. So $4,000 revenue they earned in cash. They paid $1,000 of salary in cash, and that was basically it. But when you come to your accrual accounting, you will see we are going to record every business transaction, irrespective of the fact whether cash exchange took place or not. Okay, so revenue is $9,000. $4,000 was in cash, $5,000 was on account, but we still recorded it. Salaries, $1,000. Obviously, you paid cash in this one, you will still record it. Utilities, okay, your electric bill, $200. You did not pay it yet, you just received it, but you have incurred an expense. This is the expense for the month of September. So you will record it in your financial statements for that particular month. And you would see the net income for this business when they follow accrual accounting is $7,800, and when they follow cash based is $3,000. So you would see same business, same transactions. It's just a matter of what accounting they are using. Okay, the results could be very different. Now, in terms of revenue, okay, what is revenue? IFRS, which is your International Financial Reporting Standards, they describe revenue as inflow of economic benefits during that period, which is your accounting period, arising in the course of ordinary business activities. Focus, ordinary business activities is your primary business. Whatever business you are engaged in is your ordinary business activity. When these inflows, so inflow of the revenue increases your shareholders' equity. Now, we will just pause here for some seconds. Okay, remember our previous PowerPoints. Revenues increase shareholders' equity, and that is exactly what the IFRS is talking about here. Okay, so when these inflows will result in increase in equity, you will know that you have earned revenue. But there is a difference. Okay, so that money must come from your ordinary business activity. It cannot be that your equity or your shareholders' equity is increasing because of contribution from partners. or owners. If you are putting money in your business, it's also going to increase your equity, but that is not going to be revenue. So please, early on, just let's try to understand. Okay, revenue as defined is, okay, any economic inflow coming from your ordinary business activities that increases your shareholders' equity. Three basic conditions. Okay, the ownership of control, or you can say the benefits of the goods or whatever you are selling, have been transferred to the customer. So the customer must have the ownership or control and be using that product for their benefit. Or you have provided some kind of service. Okay, let us say you have an accounting business. So you provide accounting services to your customers. Okay, when you provide that service, obviously your customer is getting benefited from your service. That is your revenue. Second, the revenue should be reliably measured. Means you should be able to reliably measure your revenue. And the third one is basically very, very simple, and it's more logical. Okay, it's probable that your business will receive the economic benefits. Obviously, if you provide services or products, eventually, okay, either at that time or eventually at some point of time, you are going to receive the economic benefits from those transactions. And obviously, at some point of time, you will receive cash. Okay, your customer might not pay you at that time, but at some point they will pay you cash. So these are the three conditions of understanding and recognizing revenue. There are more IFRS standards from the year 2017. Okay, because obviously we are talking about very, very basic accounting over here. We will not go in that many details. When time comes where we have videos of intermediate accounting, we will talk more about these other points or new standards, you can say. Now we spoke about the revenue. Okay, what is expense? Think about when you earn revenue, there are different costs that you incur. Okay, costs could be your salaries, wages, okay, fuel, electricity, anything, any cost, supplies you use. Okay, so how will the IFRS define it? They will define as a decrease in future economic benefits. Remember, revenue is increasing your economic benefits because money is coming in. Expenses, the money is going out. So decrease in future economic benefits because of a decrease in asset or increase in liability. Decrease in asset means, let us say, for example, easiest way to remember or understand is you are paying cash. So your cash is going to be decreased because of something. Okay, because you're going to pay a bill. Your asset is going to go down because you will pay. Or you might not pay at that time. You're going to say, well, I'm going to pay in about 10 days. Still, it's an expense because you are recording a liability. If you remember, we're talking about accounts payable in one of our previous classes. Okay, that kind of liability. And the second one is most logical. Okay, your expense should be, you should be able to reliably measure your expense. You cannot, how can you record a business transaction if you don't know how much to record? Okay, so this is more logical. Same thing with the revenue and expense. Remember I said in the revenue part also, very, it has to be very logical. You should be able to record. You should know exactly how much you're recording. Okay? Now, adjusting entries. Okay, before we get into adjusting entries, I would like you to remember, okay, when in our initial presentations, we were talking about trial balance. Okay, I had given you an example of a corporation. They started a new business in which they invested some money, they bought some supplies, okay, they paid salaries, things like that. Okay. And then with those entries, what we learned how to record debits and credits in T accounts. And from those debits and credits, we learned how to make a trial balance. But there is one thing that you must understand at this point is that trial balance is unadjusted. In simpler words, it is unfinished. Or you can say it is not final. Because if something is not final, you cannot use it to make your final financial statements. You cannot use it because it's not complete. In order for us to complete those transactions, we need adjusting entries. Adjusting entries, okay, changing. Okay, you are changing some entries here and there. Okay, that's the easiest thing that, easiest word I can think of in order for you if you ever get confused. Okay, you are making some changes to your accounts. So in other words, you are adjusting. Okay, so that trial balance that we spoke about before is called your unadjusted trial balance. When you add adjusting entries to the unadjusted trial balance, you get your final adjusted trial balance. Okay, unadjusted simply means your accounts are not ready for you to compile or finalize your financial statements because they are incomplete. Okay, now what are the reasons for adjustments? I've given this, the last 2 points here. We must ensure that all assets and liabilities are recorded at the end of the period. Okay, end of the period could be your month or your year, whatever your period is. Okay, so January 1st to January 31st. January 1st is the beginning of the period, January 31st is the ending of the period. So all your assets and liabilities, any changes must all be recorded. Same thing with your revenues and expenses. They must be recorded in order for you to finalize your financial statements. Okay, and if you ever want to go back in my series, you already have that video where I taught how to make the debits and credits entries and the trial balance. There are 3 basic kind of adjusting entries. In today's class, we will only do the first ones. Okay, but I'm going to talk about a little bit about all 3. Okay, so one is deferral, the other is depreciation, and third is accrual. Okay, 3 kind of adjusting entries. They are the main kinds. Okay, then obviously there are different examples or different ways you do these entries. So today we will talk about deferrals. Okay, so what is a deferral? Okay, when you receive or pay cash in advance, either you receive cash or you pay cash in advance of providing or receiving a good or a service. I will say again, you receive or pay cash in advance. Okay, why would you pay cash in advance? It could be that maybe you are trying to settle a bill. Okay, you are paying in advance, so you don't want to get bothered by those invoices. You say, okay, well, example is my rent. Okay, let us say you have a rent every month, you are paying some money. Okay, your landlord comes, they say, hey, listen, if you pay 3 months in advance, 5 months, I'm going to give you a little discount. You say, okay, well, I have some cash lying around, I'm going to pay you in advance. So now I'm okay for this 3 or 5 months, whatever that time is, and I don't want to get bothered. So what you have done, you have provided cash in advance for something that you have not used. You have not used that entire month or the entire 5 or 3 months of rent, but you paid in advance, right? So you're paying cash in advance of receiving that service. Or somebody gives money to you. Let us say you have a business, somebody comes, they say, listen, this is your advance deposit. I want you to provide me service these many times in a month. And please don't bother sending an invoice because I am just, provide me, an invoice right now, advance invoice. Okay, I'm going to pay you the money right now. I don't want to get bothered. Please accept this advance deposit. So how we deal with these entries is part of deferrals. So what we will do is I'm going to quickly shift to the Excel sheet. Okay. Example. You paid 5 months advance rent on January 1st. 5 months of advance payment for your rent on January 1st, $5,000. So it's 5 months. Obviously, the rent per month is $1,000. So what do? You record an asset named prepaid rent. So what you will do is on January 1st, you are going to record a prepaid rent asset. So $5,000 prepaid rent, and you paid cash, so cash credit $5,000. Okay, you would see this cash T account. $10,000 was your beginning balance. So obviously this was from previous year. This is the balance you started your cash account. What you did, you paid $5,000. Okay, we will just quickly do the final balance here. You will see this is $10,000. Okay, and subtract sum of all these, because we're going to be doing a couple of postings. So I just want to make sure that we get the final amount. So your cash final amount over here for now is debit. The balance is debit 5,000. You started your cash account $10,000 and you paid $5,000. Now I will talk a little bit about prepaid rent. Okay, you might be thinking rent is an expense. Okay, we have to pay, but why are we calling it an asset? Well, we are not calling rent an asset. We are calling prepaid rent an asset. And the reason we call prepaid rent account an asset is because you will use this account for your business. So in future, you will use rent. Obviously, why? Is because you will have to use that building or you have to use that office to earn money. So you will use this for future economic inflow. Economic inflow, in other words, is money. Okay, so you're going to be earning money by using that particular office or that building or that factory, whatever that is. In advance, you have paid for that rent. So this becomes your resource. Remember the definition of asset: any economic resource that you control that helps you make money, helps you generate cash. So this is the resource that you control. Prepaid rent, $5,000 debit. Whenever we increase an asset, debit entry. Okay, let's talk about the next one. You purchase office supplies on account for $700. So office supplies, asset, $700 worth of supply you just purchased, but this time you did not pay in cash. You paid in with account. Why? It's because you have an account. Okay, you have a contract. You're going to pay in 1 month. So accounts payable credit $700. You will see now your accounts payable has a balance of $700. Okay. Third one, on January 31st, now you need to record your expense. To be more specific, you have to record your rent expense. Why do you record your expense now? The reason is because you used that month rent. You have used the rent for that month of January. You used it. So now you have to record. So on January 31st, you will record rent expense. Rent expense for 1 month was how much? $1,000. So rent expense debit. And where did this $1,000 come from? Obviously, it didn't come from cash because you have already paid cash before. So where did it come from? It came from your prepaid rent asset. So instead of $5,000, now your prepaid rent asset is going to go down $1,000. And you will see that now the balance for prepaid rent is $4,000. So 5,000 was the beginning balance because you made that payment. You used 1 month of rent. Your balance is debit $4,000 in prepaid account, prepaid rent account. Okay, next one. So on January 31st, you went into the supplies room and you counted your inventory and you found out that you only have inventory worth $500. That is what the office supplies are remaining. How much did you buy? You bought $700 on the 1st of January. But on 31st, you find out only $500 is remaining. So you have used $200 of office supplies. Okay, same concept about expense. Whenever you have expense, you must record a debit. And again, if you ever need just a brush up of why debit and why credit, please feel free to watch my debits and credits and the early on videos and you have enough information there to clarify all your doubts. Okay, so supplies expense, $200 debit. And where did these supplies come from? These supplies came from your office supplies. Okay, so office supplies was $700. $200 you have used. So your office supplies balance now is $500. So you see, you paid in advance in the beginning of the period and you used those assets and you recorded expenses. This is your adjustment. So what you have done is you have adjusted those accounts. You have made adjustments to the prepaid rent account. You have made adjustments to the office supplies account. They have changed. You have made changes, right? This is your deferral, an example of deferral. Okay, and obviously I don't have to go into too much detail about all the basics. If I ask you, okay, what will be the entry if you decide to pay the $700? What will be the entry? Well, simple. You will pay cash for 700, so cash credit and accounts payable debit. If you decide to pay the entire amount, then $700 cash credit and $700 accounts payable debit. If you decide to pay part amount, whatever that amount is, let us say you say, well, I'm going to pay $500. Okay, no problem. So $500 cash credit and $500 accounts payable debit. Okay, let's see the next example here. Okay, and again, before I go to the next example, I just want to point it out, just so you know, we are always making sure that our accounting equation is balanced. You will see in the first transaction, okay, we had paid cash and made another asset of prepaid rent. So how did it affect our accounting equation? On the asset side, one asset went up, which is your prepaid rent, and one asset went down, same amount cash. So your equation is balanced. In the next one, you had purchased office supplies on account. So your office supplies is an asset. So your asset side went up $700. At the same time, you recorded a liability. The liability went up $700. So your equation is balanced. Okay, please, no matter what business transaction you are engaging in, and it does not matter if it is a simple transaction or a complex transaction, because believe me, we are going to be doing some complex transactions later on. It doesn't matter. Your accounting equation must be balanced. Okay. Sorry. Third one. Okay. You had adjusted your accounts for the rent. Okay. So $1,000 came out of your asset, which is your prepaid rent. So $1,000 came out of the assets. At the same time, because it was an expense, your shareholders' equity also goes down. So asset side minus 1,000, shareholders' equity side minus 1,000. So equation is balanced. In the next one, you had adjusted your supplies because you found out that in the course of the month, you used $200 of supplies. So your assets went down $200, obviously because from the supplies account. And $200 came out of your supplies account and you recorded your supplies expense. And when you recorded your supplies expense, your shareholders' equity also went down. So $200 went down on the asset, $200 went down on the shareholders' equity. Accounting equation is balanced. Okay. Now, in these examples, you had received, or actually you had paid cash in advance for an asset. Okay. So you paid cash in advance of rent and you made your prepaid rent asset. And you had purchased supplies, which is our asset. So you paid in advance early on. Now, how about you receive cash before you provide a service or product? Same concept, it is called deferral. Okay, so deferral is paying or receiving cash in advance. So in this example, On February 1st, you received $2,000 in advance for providing auditing service in the future. So auditing is part of your accounting business. Remember I said, well, imagine you have an accounting business and you provide auditing services to businesses, okay, where you audit their statements, okay, and then sign and say, well, okay, this statement is as per all the rules, and you sign and say, okay, and that is your auditing basically. So a business gave you $2,000 in advance for providing auditing service in future. Each auditing service, every time you audit one of their statements, you charge $1,000. So they paid you $2,000 in advance. So this time cash came in your business. Okay, the first one, the easy one, is $2,000 cash came in. Okay, let's see what happened on our T account. So you can see this debit entry here. $2,000 came in, so debit $2,000 cash. Okay. At the same time, now you will record something called unearned revenue. Okay, $2,000. Why unearned revenue? Well, this is the revenue that you will earn in the future that you have not earned right now. All you have done is you have received cash. You did not provide any service, and until you provide that service, means the benefit must transfer. You cannot record a revenue. So you will record unearned revenue, and unearned revenue is a liability. The reason why unearned revenue is a liability is because now, since you have accepted cash, it is your responsibility and it is your obligation to provide service to your customer. It's your obligation now. So it becomes your liability, your responsibility. Okay, so $2,000 unearned revenue. So we create a new liability account which is called unearned revenue. You will see whenever the liabilities go up on the credit side. Now some businesses might decide to call this account as advanced deposit account, which is also fine, no problem. You can call unearned revenue as advanced deposit. Obviously, why is advanced deposit? Because somebody is paying you money, so you can provide either a good or service in the future. Okay, so let's see what happened to the accounting equation. You received $2,000 cash, so assets went up $2,000. At the same time, you recorded a liability of advanced deposit or unearned revenue. Your liabilities also went up $2,000. Accounting equation is balanced. Okay. On February 10th, you provided the first of the two auditing services. So on the 10th of February, okay, you provided the first part of the auditing services. So there are two financial statements they want to get audited. On the 10th of February, you audited the first statement. Now what happened? You have provided that service. So the benefit has been transferred. Now the customer has realized that benefit because you provided that service. Now you can record your service revenue. So service revenue, credit $1,000. Remember, revenue increases your shareholders' equity, so credit. Now, where did this $1,000 come from? Obviously, the customer has not paid you now. The customer paid you from before. And that money was recorded in your liability account of unearned revenue. So this is where that money is going to come from. So let's see what happens. So debit unearned revenue. You will see the debit entry here. This is the money that you have used now because the first service you have provided, which is worth $1,000, the balance of your unearned revenue account is now $1,000. Means when you provide the second time auditing service, you have used all your advance deposit. After that, now it's up to the customer. They want to pay in advance later on, they can pay, or they can just, request your service and pay you after you have done, or after you have done auditing your statement, their statement. They can pay you cash. It depends on your relationship with your customer. But as far as these $2,000 are concerned, every time you're going to provide a service, you will be using the balance from your unearned revenue. Okay. Now let us say on February 10th, the customer says, well, you know what? Instead of one, just do both of them. So no problem. In that case, your service revenue will be $2,000 because now you're providing services for two statements, and the unearned revenue debit, the entire amount has been used and your final balance is zero. Okay. You will see that. Okay, let's go back to our example. I don't want to confuse you. This was just, I was just making up new, situations where you could understand what's going on. But let's go back to $1,000. Okay, in this, let's see if the accounting equation is balanced. Your liabilities went down $1,000 because you had provided $1,000 worth of service. Liabilities have gone down, and at the same time, shareholders' equity went up $1,000. So nothing changed. Nothing changed. Okay. Your right side of the balance sheet increased and decreased with the same amount. So nothing changed. Net zero. Okay. These were some examples of deferral entries. Okay, let's go back to our PowerPoint. This one. Okay, so just going back again. Okay, your deferrals. Okay, something that you have made prepaid. Okay, when you either prepay in advance or you receive payment in advance. Okay, so either you are paying for something in advance. Let us say you pay for rent, insurance, supplies. You record a deferral. Okay, this is recorded as an asset. Remember, when we paid for supplies, the supplies became an asset. When we paid for rent in advance, it became an asset called prepaid rent. Okay. Why? Is because it will provide future economic benefits. And what if you receive payment in advance? Well, you have received payment in advance. For example, advance deposit for providing some kind of goods or services. Okay, this is recorded as a liability. And in this particular one, in this, when you are receiving a payment in advance, then the future economic benefits will transfer to the other business, not your business, transfer to the other business. Okay, the benefits. And at that time, at the same time, you will also earn revenue. Okay, so you must understand, okay, your revenue is an expense to somebody. Your expense is a revenue to somebody. When you provide a service, you make money. Okay, so in one way, the economic benefits come to you. At the same time, you are also providing benefits to your customer. Okay, so that's how your accounting works. Okay, that's the concept of accounting. Okay, so in both ways, you will be making money. In one way or the other, you will be making money. When you have an expense, obviously, why do you have an expense? Because you are in business. Okay, you make money and you have expense. And when you receive payment, why will you receive payment? It's because in future you are going to provide some kind of services to the customer. Still, at that time you will earn revenue. So economic benefits will still come back to your business. Okay, they will inflow your business. So that was our deferral part of accrual accounting. Again, this is 3 parts. In the next presentation, we will be talking about depreciation and accruals. Okay, so that will be part of our next presentation. And what I will do is, once we are done with these adjusting entries, I'm gonna have an example, a holistic example, where what we will do is we will record debits and credits, we will record a trial balance, and we will record adjusting and closing entry. So it's gonna be the entire example is going to give you a real life presentation of the entire accounting cycle. Okay, thank you for watching. In the comment section below, please let me know your thoughts about the content and what other topics you would like me to explain to make learning easy for you. Finally, Please don't forget to hit the like, subscribe, and hit the bell icons below to get the latest notifications of our videos. See you soon in the next class. Till then, take care.